following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. Hope you had a good weekend. It was a dandy weekend around here in the Philippines, as always. We're gonna initially talk a little bit about something that we spoke about last week, kind of in a little bit of a parallel fashion. Saudi Arabia opens equity markets to foreign investors. What does that mean? That means that they're allowing foreign investment because of the oil slump. You know, their GDP and a couple other things have probably fallen off a little bit here. And what they're doing is opening up their stock market to direct foreign investment for the first time ever. And if you remember last week, you know, we had talked about the Philippines having, you know, a pretty big referendum, and I'm thinking they're going to do this in 2016, open that same type scenario in the Philippines over here. And that's in line with some of the things that Eric and I spoke about in South America, some of the things that have happened in Asia before the Vietnams get pumped up. We talked a little bit about Mongolia, of all places, last week. And, you know, these, you know, money chasing the latest flavor of the times here, if you will. So Saudi Arabia's kind of pulled that stunt. The Philippines is seemingly going to do the same thing. It creates really good opportunities, and that's one of the things that, as an investor, you're always looking for is what's kind of the next, not Wild Wild West, but what's the next, not bubble, but the next thing that might be something that people are paying serious attention to. And obviously, the bids may go up. So again, another country seemingly going the same route. Is that a good thing or a bad thing in the long run? I think in the short run, it's a great thing for investors, but in the long run, you know, you'll see inflation happen. That happened in Colombia, happened in Panama, happened in Vietnam, happened in Bangkok. So again, you know, these are kind of very short-term opportunities. I think where, you know, the crowd starts following suit here. It just creates nice little markets for a while here for investors. So again, one of the other things we want to talk about initially is Greece. You know, no mystery whatsoever to me or a lot of you guys listen to the show. We've been talking about this. Talks break down. Euro's not getting hit that much. Dollar strengthening a little bit. Seemingly gold should have rallied a little bit more than this off of some of these unfair lows on the daily. I'm going to go back to the August contract here. I'm going to focus on this for a little bit. And don't tell me we're not going forward. This is our daily chart here, and we're already having issues here. Here we go. All right, so looking at our profiles here on the daily situation. Waiting for these to pop up, and here we go. We're in business. We talked about the inflection points to pay attention to here on the daily. This 1170.5 down below, up in 1196.2 up top. We got very close to that this morning. Came off of it. I thought we'd come off it a little bit harder than we did. So we reached a low of 1171.9. That's in the very similar neighborhood as that 1170.5. So again, I would think, you know, the dollar rallying is not the best friends of gold right now, or commodity prices in general. But you would think, with massive breakdowns in the Greece talks, you know, that gold would at least get above 1196 and above profiles, and it's just not seemingly wanting to do anything on a large scale here. So something to pay attention to for gold bugs who are looking for good long opportunities. I would not be extremely excited about this particular move. On that note, let's just get right into a couple other commodities that are dollar driven, obviously, and then we got some technical situations here on November beans, new crop beans. Again, we're looking for a close below this $9 neighborhood. this morning seems like, we bounced off of a little bit on Friday, talked about that. More than likely, hopefully we'll see a daily close below $9. If we see that, that's going to be some serious technical damage again for beans, looking for this to drift a little bit lower. We talked about targets even as low as $8.25 a bushel on this. It's not going to be a smooth ride. And as you have noticed, we have broken stride and been forced to sit on the sidelines a little bit as we had gotten above profiles, talked about not wanting to go long beans based on those weekly profiles. And as we look at this, talked about get back in the water below 913, and we're at the precipice here, the cliff. Need to see a daily close below $9 a bushel, and that's going to just possibly bring out some shorts here. Take a look at treasuries real quick. September contract on the 10-year. Talked about inflection points last week, actually, before we were looking at that PPI. Talked about 125.24 up top and 124.23 down below. We've hit that 125.24. We hit that on Friday. We backed off. Isn't that nice? Reached a high on Friday of 125.23. So created a little bit of a trading opportunity. Talked about those inflection points, trying to lever off of those, and now we're kind of crowding back above. And in my opinion, the U.S. stock market may sell off even farther here, and you got to keep your eyes on trading breakouts above 125.24 on the 10-year Treasury now, even though that was a decent little trade on Friday on the short term. We're going to continue to look at a couple of things. Remember, we're shifting a lot of index futures here into September. We're also looking at the NASDAQ here shifting in September. Let's pull up some numbers on that. And here we go on the NASDAQ. As you can see, hit some inflection points on the September contract, now trailing below 43.97. Going to be some targets down below on the NASDAQ. Got to pay attention to that. We're going to take a look at our index breadth situation here. Go into our daily. Guys, globally, this is our daily view on our profile breadths. As you can see, the red arrows here, you can barely see them. You've got one index that's been up today. That's the Nikkei on the day. And the heat maps actually tell us that we're breadth negative on all of our daily views here, except for the Thai-Set 100, which has been beat to crap lately, and the Shanghai, which is still just unbelievable. Here's the weekly situation. That's pretty bearish in the long term, guys. Just keep that in mind. Here's our daily. Here's the 4 hour. We're not open yet. Shanghai, only thing positive. Not a nice situation here. Let's take a look at our S&Ps. As we had talked about the note bond situation, still got a little ways to go. This is our September contract, 2066. We were talking about 2068 on the June contract before, so 2066. Excuse me. And on the weekly, we've got that 2060 down below. So I think, do we have a caller, Eddie? Is Eddie on the phone now?
Hey, John. I don't know if you hear me, but I'm here.
Yeah, great. Nice to hear from you today, Eddie. How are you?
Good, John. Good. Probably
Great.
same good as you are. You know, good. Nice weather.
Great. I tell you what, we got about 4 minutes before we go to the first break, and what I wanted to do, I wanted to kind of peruse through the usual suspects, and the reason I'm so happy you called today, because the reason we want to talk a little bit about some option strategies today and some general tickets to hopefully take advantage of some of the situations that we look at on a day-to-day basis. And our automated systems kind of got a block out the other day on the S&Ps, got stopped out. And case in point, I wanted to talk specifically about an S&P strategy, maybe a gold strategy, maybe a euro strategy that folks can possibly buffer some noise, if you will. As we were strictly trading the underlying instrument the other day, we got stopped out of that trade. But how do folks out there? I know there's a great Thinkorswim show that has come on TFNN here and there. They talk about option strategies. They talk about how to find optimum option strategies, but we're going to hopefully drill down in some of your favorite ways to look at some of these markets based on what the bias is on the underlying in general. Now, Eddie, I'm showing the euro right now. I'm going to pull this up, and you and I had been specifically talking about this 112.25 area, and I think you and I both are pretty bearish on the euro in general. On the weeklies, on the long-term view, that's without question. I want to know, just kind of starting here, we got about 2 minutes before we go to the first break, what kind of option strategy, in your opinion, would possibly be appropriate for trading the euro right now?
To trade the euro, what worries me a little bit, situation as on a weekly distribution of our balances of boxes, so-called.
Yeah, I'm going to go back to that.
Mm-hmm. Daily 123, 112.23. It got me off yesterday, also on the losing side when market showed. Here we go. That's okay. I'm going back to the weekly chart.
Okay.
Since the chart is, if you count the profiles from the time when euro start descending from 140s, what worries me, it's actually I'm start imagining, but what does worry me is a price did not had even a glimpse above boxes. It's a 6 box on the weekly chart that price has not even attempted to go above above unfair highs. That what a little bit worries me. Again, this is imagination. Maybe I know too much, but I'm waiting for a little bit of flush or shakeout of the weak shorts, and okay. Well, market on the weekly is balanced, correct, John? Because correct. It's inside of the box, right? So, euro is in a very bad situation. Greece is failing to produce its agenda as we speak. The euro should be tanking like deadbeat, without having a bounce, but it's not going lower. So, somebody. Mm-hmm.
That is concerning.
Somebody else knows from the big players in this industry what we don't know. Actually, maybe there is a wait for the tomorrow's, Wednesday's FOMC meeting. I have no idea, but it's not responding to the fundamentals. It should be going down. It's not going down. So in order to get this thing on board, actually, you need to imply options. That means reduce your deltas. What the delta is?
Yeah, let's hold that thought. We're going to come back from the break and get into more of a hardcore strategy with this. And Eddie's going to guide us through this, guys. We'll be right back.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. Eddie, you still there?
I'm here, John.
Great. I had a little bit of issue with the chart. Got it back up. I hope you're seeing this. So, sometimes, people are sitting on the edge of their seat. I'm one of them. And, you want to act. You always have to kind of put the reins on sometimes, when there's just not the ripest opportunity there. When we look at the euro, is it the time to do anything with this or not? And we talked about an option strategy, maybe to take advantage of. Is there a reason to do something right now? So I'd like for you to, if you could possibly go through that scenario and where we're at with this thing.
If trader would be able to identify market conditions, there is always some time to do something, as long as those conditions are identified properly. White box, white profile on a weekly basis, on a weekly price chart on euro suggested as that market can be non-directional, and that been confirmed by price jumping over the 112.23 area, which is unfair highs on daily profile, and going back and forth over this level, neither continuation to the upside, neither continuation to the downside, rejections from both. So suggested that market is non-directional. If market is non-directional on a short-term basis, on a daily basis, comparing to profiles, and its balance on the weekly basis, on a week in terms of weekly profiles, I tell you what we've done. We shorted volatility. That means we took it. We shorted premium. We shorted 13.5 calls for the week expiration there, so they're offered by weekly expirations, and we shorted 11.5 puts. That means we created so-called strangle, short strangle. And additional reason why we done that, because we looked at the pricing, implied volatility. We received significant amount of money. We received per both legs 125 pips. That means a lot. Our break-even was 14.75 on the upside. That means strike price chosen plus premium received, and 10.975, 0.1975. That means strike price below minus premium received. That gave us approximately 3 basic points range. Within a week, that price would stay that, and luckily, not luckily, but as we projected, the price finished in 12.5 area. That means right in the middle of this, without this trade went very good. That means there's always something to do, and information that we could have done came from the two profiles. How price is acting on daily, among daily profiles, and where the price is in relation on weekly profiles. In addition, weekly profiles is wide, suggesting that volatility will continue.
Okay, so that being said, what Eddie just stated was there, in case you guys didn't know this, there's not only, monthly expiration options on currencies, there's weekly expiration options. Eddie plays those a lot, and it's really cool how you do this sometimes, because I've watched you're trading weeklies against monthlies, so you're trading weeklies against underlyings, trying to balance deltas, something like that. And for guys out there who listen to the show that are not big option traders, one of the things that Eddie really focused on with that strategy was basically, he said the number 114.75. That was the safe landing area up top, based on the puts that were sold down below and the calls that were sold up top. And where does that 114.75 lie? It lies right at the weekly unfair highs. So we would expect, even if the volatility increases and even if the euro goes up, we still got a little bit of a border up there around 114.68, which are those weekly unfair highs. Now, a little bit of a buffer up top, 114.75, whatever, it's in the same neighborhood. But as that particular trade, if it had, with the Greek thing out there, there's a lot of options are relatively pumped up in this particular instrument. Even as that trade possibly would, go, I'm just going to call it against us and start approaching the 114.68 border. At that moment, Eddie, what are you thinking? Are you thinking about balancing that trade out a little bit with some underlyings, or what's the mechanisms going through your mind if that starts getting into the land of the borders? We're going to answer that question, folks, when we come back from this break. And Eddie, if you can hang around, that would be awesome.
My pleasure, John. My pleasure.
Great.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Eddie on from Spain with us today. Thank goodness. And one of the things that we were talking about as the start of this Euro type option trade was, we want to sell premium when volatility is high. That's just a standard option 101 statement. And when we had this orange bar appearing, this is our long-term weekly view on the Euro. We knew this box was going to be super wide and relatively volatile on the close of that week where we had that orange bar. So that's kind of when this mindset started. We know option premiums are probably going to be relatively high. They've been relatively high on the Greek situation, and Eddie has been, kind of talking the talk and walking the walk about an option strategy that we did on the Euro. So, Eddie, my last question to you was, let's just say this thing kind of got to the upper border around that 114.68 area, still within the safe landing area. What are you thinking to kind of fix or repair an option strategy that's not yet, thrown up, but kind of on the border of concern situations? Eddie, you still there? Okay. We don't have Eddie anymore? Is that true? Okay. Eddie?
Hey, sorry, John.
Okay.
I was talking to myself, but yeah, my mic was accidentally was off.
Right.
Yeah.
Okay. All right. Let's get right into this euro going into the upper border, and what are you thinking when things like that happen, when an option strategy selling premium is getting a little tenuous?
Okay, that was a very good question, John, before you ended your last segment. What trader needs to do or when position goes sour, when market does a little bit unexpected things and gets out of the control or gets close to your selected strike prices? That's a very good question. This type of trading always, initially it's named to be regulating deltas or delta neutral plays, right? So we know delta's getting better. I'm just going to explain to your listeners or viewers what the delta is. Delta is percentage of change of the option in respect of the percentage of change of underlying. That means if the delta of option is 50%, that means delta value, option value will change half of what underlying will go. So when delta gets a little bit, negative, that means when it gets closer to your selected striking prices, there is a plan B. Of course, always needs to be plan B. That means typically we use, because volatility is there, you do roll ups. That means I do have initially, if you remember, position 13.5 calls and 11.5 puts, both of them short. When market dipped into the 11.5s, it was during the life of that week. That price was at 1140-ish area. We just simply bought our back with the loss, our puts, and we rolled them down to 11 evens. That means you still in the game, you're receiving a little bit less premium, you're losing on that, but in that case you're reducing you're extending your range and reducing your risks or reducing the deltas. That means rolling up. In this case, this is a best case scenario. Why rolling up? Because the life of options, if you remember, was selected weekly. That means they've been expiring on Friday, and that event happened actually on Friday. So there is no need to get more sophisticated by puts or something else, or get underlying. Typically, you just roll up or roll down your option strike prices, buying to close your initial position and selling to open a little bit lower. In this case was a puts.
Okay. All right. Well, I'm glad to get your thoughts on that. A lot of guys out there, when people are selling premium, as you know, Eddie, those seem to work out quite a few times in a row, and then when they don't work out, they can be extremely painful. And if you're selling premium,
statistically, John, 80% of the time, 8 trades out of 10, there will be successful trades, but two trades out of 10, they will, blow price goes through your levels, and then you're going to lose maybe 200 or 300% of your investment.
Yes, and that's why, if you're trading options, I'm not a huge fan. I mean, there's some people like the guy you're listening to right now, Edmundus, who balance an equation very well. For those of you who are kind of not sitting in front of the screen all day, or a little bit more in the investor camp, selling premium can get ugly. So a lot of times, we will tell people on some of the picks or the strategies that we put out there, it's like, oh, it's time to sell volatility. You'll want to buy wings out there, and that means buy some hedges for yourself, possibly limit some of your upside. If you can't sit there and monitor the equation like Eddie's talking about, shifting some straddles around, some strangles around, maybe buying a little bit of the underlying to try to get a little bit more delta neutral on the mousetrap. It's something that has to be monitored if you're going to do that. And a lot of times, Eddie, as you know, and we're going to fold right into the S&Ps based on what we're talking about here. Case in point, we're going to go into the September contract, and we're going to talk a little bit about another type of strategy that, pretty much goes hand in hand with a long-term play that we're looking at, and that would be, Eddie, as we've been talking about this one for a while, the S&Ps and the breadth situation. I'm showing our scanner right now. This weekly breadth rolling over to negative, and pretty much, on a closing basis so far staying negative. That hasn't happened since October 24th, and that usually gives us a decent chance to try to take a somewhat of a long-term short stance in general on the index. This one being the S&Ps for a little bit of a time frame. Now, can it bounce back? Yes. Can it flip-flop around just like we had a rally last week, 30, 35 S&P points in our face on a short that we had to personally get stopped out of on the underlying? How would you look at a situation like this opportunity that's happened? It's June. Last time we had it happen was October. How do you look at something like this, Eddie, and try to develop some type of option play that's going to allow you to maybe kind of buffer some volatility, yet still stay with the trade?
John, for the record, we've been not stopped out. Just because exactly into the team, you don't know about it. That's probably news to you. But we started with options. We We lowered the deltas, right? So we started options. You asked me, what you're doing last week when on June 5th, on 2015, our weekly bread on S&P turned negative. This was the first time since October 22nd of the last year, 2014, and I took that seriously. I took that very, very seriously, and we situated ourselves with the long puts, out of the money puts, August expiration. That means 3 months to go. Very, a low risk to the time decay, blah blah blah. But why we haven't been stopped out? Because those puts gave up half of its value. Because I shorted June 26th expiration, which is also weeklies, right? Weekly expiration, it's right now we shorted puts also. So we created like vertical debit spread, but calendar sort of, right? So short leg is expiring quite much faster. It's acceptable to time decay. And the puts, of course, will expire way, way longer, which is not that acceptable to time decay. So what happened? We lost on long puts, of course, lots of money, but also our short legs of the puts, they also lost money. So we experienced losses, but not that much. And on Friday, it's closed. Like with a hawk, with a loop. I was sitting there and watching every tick, penny, percent of how our market bread will end up the week. And it ended up what? Again, negatively by 2%. Right. As you probably know, what we done it on week on close, we bought another puts because, the second week in a row that actually this market bread closes negative. Take a look. We have a gap down, so we experienced lots of money. Again, we're not going short naked. We bought a puts, and I lowered a little bit strike price of the puts. I went to the at the monies 2085's puts, but again, I shorted 2035's June 26 expiration once again, just in case. As I said, this is a vertical debit spread with a calendar twist. So I think. You asked me to talk about options. That again, and we just fit our portfolio just fit right into the your today's whatever team, right? So yeah, I have not been stopped out, and that's only because of them trading options, on this thing.
Right. Yes, and I understand what you're doing, and that's great information for everybody to hear. Eddie's doing a little bit more of a sophisticated option strategy around this unique opportunity, I think, right now with the weekly bread changing tone. Our automated systems is what I was speaking of, and we have to take our medicine when, we have trades on and we're trading just strictly the underlying. And that's why I wanted to talk about, and that's part of trading. We talk about that all the time. It's lose a little, make a lot. When we talk about option strategies, those have some mitigating circumstances that you can kind of, I hate to use the word play around with, but what Eddie was talking about was kind of massaging that kind of core position of we've got a short bias and we want to kind of milk this thing and readjust it. Now, for most people out there, Eddie, we've got about 4 minutes before we go to this next break. let's just say we've got a long-term signal, which we have had now, and we're above profiles on the weekly. We were kind of above profiles on the daily, which was really weird when we got that signal, as you know. I call it a gift. If folks out there were looking for a simple strategy to trade the S&Ps based on, throwing an option wing in there and being able to kind of sit tight and let a fine wine breathe, or whatever they call it, what kind of unsophisticated option strategy would be something that might be appropriate at this stage?
Good question. Before I answer your question, I just use the 15 seconds. Just a moment ago, as we speak, we boarded calls for the just in case, to hedge our short S&P position. We boarded, let me see, 2,110 calls, August expiration, and we paid 29 3/4. So that's how we're hedging. So, we're reducing the risk in the market in case it goes higher. We just, the delta's 30%. So going back to your initial question, a very simple strategy would be, when we use guys options, you don't want to pay expensive for the expensive item. Like, you don't want to overpay for the options. So market is obviously down. There is no brainer, right? So it's going down and gapping down today. So skewed always, in addition, that puts always our more expensive little bit than a calls. Calls are getting even less expensive. That means as far as the implied volatility. So they're relatively cheap. So the best strategy is to short the future, because if you are, like ourselves, are convinced with any analytics that at your disposal, we are looking right now the longer term, weekly, based on weekly bread, that it's negative, that market is getting weaker. So the short the futures, not now, of course, at some point, what you think it's a correct place to enter, and buy calls. Buy calls out of the money, at least 3 months expiration. You can buy 2 of them with the delta, say 20. That means you covered like half of the percentage of the half of your position now. Your market gets higher, it starts climbing higher. You don't need to do, of course, anything right away. That means calls deltas will be increasing in their percentage value. That means you'll be making back on your insurance more and more, and you'll be covered more and more than the 50% of your position. And if the market keeps going higher, the call is getting farther and farther from the price level you entered, and they will be losing less and less because their deltas will be diminishing. And plan B, if the price goes even lower, you can start selling puts, or if the price goes higher, you can start selling calls, covering for cost of your long calls. So, but that's probably would be on the next segment. So simplest strategy: short the future, buy cheap calls. 3-4 months to expiration, out of the money.
Okay. Thanks for that input on the S&Ps. We got about 15 seconds before we go to break here. I'm going to kind of tee something up here also before we go to break. Just kind of throwing this out there. I'm going to pull up our gold chart here. Where is it? There we go. We'll talk about gold when we get back, guys.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open, even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, welcome back to the show. We've got Edmundas Catinas on with us out of Spain, and we were kind of summing up the S&P trade a while ago. Eddie was talking about, you know, we got a long-term signal. Let's just kind of go back to the S&Ps for a second here. We had a long-term signal that I trust highly, that weekly breath crossing over to negative, which hasn't happened since October 24th of 2014, and that's just awesome when something like that happens. You know, doesn't happen. I mean, what does that happen a year average, Eddie? Back to 2003, was it like maybe average, 3 or 4? Yeah.
Yeah. On average, you get 5.5 signals, 5.5 signals per year.
Right, and it's been a while since we've had one. Obviously, it's been, good Lord, way overdue. And when it happens, it's just a great, awesome thing. But as Eddie was talking about, you know, that long-term directional play, I think maybe I missed it, but we were talking about, you know, shorting the S&Ps and buying some calls. And, you know, Eddie was talking about maybe a little bit of a ratio situation of buying more calls than the contracts you had on the S&P, right, Eddie?
Yeah, that's correct, John. Okay. You like, I know what you like, and you like very conservative situation here. You like buying in the money put. That means you can increase your leverage, guys, dramatically, because your delta is probably 60 to 70%, and you're very, very deeply covered into. I prefer. I'm sorry, guys. Here a little bit my phones. I just turn it off. I preferred using the ratios by 3 times more, say, to the each underlying, one short or long, in this case short, you would buy 3 calls. That means when the price gets there outside of the money, the volatility will blow up, and those calls will make much more greater work as an insurance policy holder, you know, rather than just going 1-by-1 ratio in the money puts in the money calls. That's why I was saying, yeah, John, you're right that you pointed out. Yeah, you need to play ratios right here.
Well, to clear that up, I mean, the theory is, you know, as the S&Ps might go down, you know, the VIX is going to explode. There's going to be some people covering. There's going to be some serious technical damage, I think, on the index charts, and therefore those option prices will you know, also theoretically increase, and therefore they will hold their value to some degree, and that's why, you know, throwing the 2 or 3 times on the hedge up top is basically the same as what Eddie was referring to. But one of my favorite trades is, if you're looking at a long-term situation, short the S&Ps, buy in the money calls, but buy it 1-for-1 instead of 3-for-1. As it's the same thing. So we're pretty much on the same page there. Let's go into gold. We got about a minute left, Eddie. This is a kind of a polar opposite situation. Got a low volatility situation here. We're trading below profiles on the weekly, just barely, just rattling around. We've had some kind of, you know, lower highs, higher lows, just kind of saying, here's our daily situation here. What in 45 seconds, what's the play on gold right now?
Play if it's low volatility, you can tell that by the price being balanced, and then it's time to buy strangle. It's the buy to buy strangle. A little bit shifted to the upside because the price is wandering in and protecting the unfair lows. That means lower end or demand area on the daily distribution of our profiles, that green line right there. And I would buy 2 to 1. That means I'm buying 1 put exactly at the price of the box, and I'm buying 2 calls exactly at the top of the box. That would be the play. Playing the volatility.
Thanks for joining us today, guys. Stick around. TFNN is stacked with awesome hosts here the rest of the day. We'll be back again tomorrow. Appreciate you tuning in. And thanks, Eddie.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.